Hello, everyone. I'm Managing Editor Cole Altom with you again for our monthly Compass preview. Joining me today is John Minnich, our East Asia analyst, and we're going to be talking about Chinese stock markets. Now, John, over the past 2 months, these stock markets were on the brink of collapse only to be saved through the intervention of the Chinese government. Beijing cut interest rates, they reduced bank reserve requirements, they forced brokerages to buy stocks, and they injected capital directly. This is not a good portent for a country that claims to want to move toward a more market-friendly economy. How can the government reconcile that claim with the fact that it clearly won't hesitate to intervene in the markets if it needs to?
Right. So, I do think that the government's commitment to reform is legitimate and genuine. I do think that we should take, to a certain extent, we should take government pledges that they are pursuing market-oriented reforms, or that this ultimately is the goal at face value. This is a legitimate goal, not only because it coheres with the dictates of the international economic system, of which China is very much a part, but also because given China's domestic reform goals, cultivating domestic consumption, improving capital allocation, submitting the economy to a limited extent to market forces will help these goals. It will help the government, it will help the economy achieve these goals. At the same time, the government's core priority, the priority that trumps all other priorities, is maintaining stability. And with the stock market, where that element of stability comes in is, at this point, primarily in terms of perception. There is a basic reality in which managing the stock market, given that you have 100 million people invested in the stock market, it does serve a core function of social control, to be a bit blunt. But there is a real aspect in which the government needs to continue to prop up these markets, because not only are they an increasingly important means of stimulating domestic consumption, not only are they an increasingly important form of corporate financing, especially for small and medium-sized private enterprises, but on a very basic level. The government won't hesitate to step in to stabilize these markets because that is its core priority, is maintaining the perception and to some extent the reality of the stability of the Chinese economy, especially at this moment when outside of the stock markets, we look at the real economy and across a broad variety of indicators, not only industrial production and real estate investment, but also retail sales, a key measure of household consumption. The economy continues to slow.
Okay, so you mentioned public perception of the stock markets, but what about their function or their role inside the economy? Obviously, the Chinese economy is a little bit different from all these different Western economies. Does what happens in the stock market actually matter? You say it's increasingly important, which means it used to be less important in years past.
Right. Well, so this is sort of the question that we take up in the Compass feature this month. And the idea is, when you look at mainstream media coverage of the stock market boom and subsequent collapse, basically, outlets tend to emphasize a few various channels in which the stock market collapse could affect the Chinese economy. One is its impact on household consumption. Another is its impact down the line, second or third order effects on the property sector. Another would be its impact on corporate financing. So these are the domestic aspects. And then finally, there's the international side, but we'll get to that in a minute. And we kind of begin by asking the question, well, to what extent does stock market price volatility actually affect household consumption? And the reality is that ordinary Chinese park the vast majority of their financial assets in savings deposits at state-owned banks. Only about 24% of total household financial assets in China are parked in equity markets. That's roughly half the rate in the U.S., less than half the rate in a country like Australia. The vast majority of ordinary Chinese citizens' financial holdings are in savings deposits, not in equity markets. On top of that, when we look at the stock market boom over the course of the last year, well, it didn't really have an appreciable effect on retail sales or on other measures of consumption activity. Now, we have seen consumption grow in a general sense, and consumption is becoming a more important driver of wider economic growth in China. But the reality is, up to this point, we still don't see what happens in the stock market translating directly to what happens in consumption activity. Very similar with corporate financing. It's becoming more important. The IPO process is certainly very important for smaller and medium-sized private enterprises. But the reality is that both private and state-owned enterprises get the vast majority of their financing either from using retained earnings, reinvesting retained earnings, or from bank loans from state-owned banks.
All right, John, before we go, I want to come back to a point you made earlier about the foreign consequences of some of this price volatility and the subsequent intervention. If it's not terribly consequential at home, is it going to have any broader impact in other regional stock markets?
So, I mean, I think that there are two ways that it would impact regional stock markets. One is another sort of question that we raise within the Compass feature, and that's this idea that of regional contagion. But the reality is that when you look at what's happened in regional markets over the course of the last year, coinciding with the boom and bust in Chinese stocks, I mean, certainly in Hong Kong, in Japan, in Singapore, you did see share prices rise. Japan, I'll set aside as an outlier because I think what's happened in the Japanese markets has relatively little to do with what's happening in China and is more a factor of the government's quantitative easing program. But the reality is that if you look at regional markets in Southeast Asia, there was a bit of a boom, but much smaller than what we saw in Shanghai. And the effects of the price collapse in Shanghai really haven't hit regional markets nearly as hard as one might have expected. And to some extent, what's happened in regional markets could also be a function of uncertainty about the global economy as a whole, with what's happening in Greece and Europe, with the approaching Fed interest rate hike, things like that. So the reality is that what happens in Chinese markets doesn't seem to affect regional markets that much yet. But I will say one aspect that we highlight, a way in which I think that what happens in Chinese stock markets, this volatility, but the combination of volatility with consistent government intervention to control the market, stabilize the market by circumscribing the market function, I think one long-term effect that's going to have on regional markets is actually beneficial. It's going to convince international investors that Chinese markets really aren't going to operate like markets as we anticipate anytime soon. And that means if you're an international investor who wants to get into Asia or who wants to get into China, Hong Kong is still going to be your avenue. Japan is still going to be your avenue. So I think that one impact of what we've seen in the last month in Chinese stock markets is a reminder, going back to our first point, that China, even though they're moving towards market reform, that is a legitimate goal of theirs. But fundamentally, the government wants to maintain stability. And it will do that at the expense of these market reforms. And for international investors, that sends an important potential red flag.
John, thanks so much for joining us today. Unfortunately, that's all the time we have. If you want to read more about this story, our August issue of Compass comes out August 3rd.